Welcome, I'm Michael Yardney. In the next 20 minutes or so, you're going to learn how to legally reduce your tax if you're in business, if you're planning to go into business, or if you're a professional. Now, you know what they say, there are only two certainties in life, death and taxes. Well, you're not going to be able to cheat death, but there are always ways that you can legally reduce your tax obligations, especially if you're in business. But I found, unfortunately, too many business owners, too many professionals give away too much to the tax man. In some cases, they lose up to half of the profits that they make to tax. Of course, paying tax is important, but in this educational webinar, Ken Race, Australia's leading wealth strategist, is going to share 9 strategies to legally reduce your tax if you're a business person. Welcome, Ken.
Hi, Michael.
This is very timely. Business people are always looking at ways of improving their profits, and clearly one way is to get more customers, get more clients, get more patients, but also another way is to stop the seepage when paying tax. So I actually asked you to put this together. It's a common issue that you have when you see clients.
It absolutely is. And what I found is it permeates all the way through the business, because there are many, many touch points that business owners can look at to actually implement strategies that'll improve their cash flow, reduce their tax burden, and leave them more money to either enjoy life or invest.
Well, what I wanted to do was go through a couple of things. So please don't multitask, turn off the phones. This is an educational webinar, so spend 20 minutes investing in yourself, because at the end of this, you're going to learn why it's important to have the correct business structure. You're going to learn some simple ways to reduce your business tax legally. You're going to understand how to manage your business for your benefit, not for the tax man. And interestingly, you're going to learn how to more efficiently use your business profits to either invest in either your business or in other things like property. So we've designed this webinar for people who are business owners who want to improve their cash flow. This is just as much for people who are planning to get into business in the future. You may as well start learning these things. And if you're a professional, really, you're in business as well. So this is for you. It's for you if you want to increase your business profits and maybe use them for investments. And if you're planning to one day exit your business, by having the sort of business that's more tax efficient, more profitable, boy, it's going to be worth more. Now, Ken, thank you for coming online to discuss this. I know about you, but some of our listeners and viewers may not. So rather than ask you who you are, because I know you're a modest person, I'd like to explain that you've had extensive business experience in both Australia and overseas. You've actually been at the coalface. You're not just a theorist. You actually have spoken to business people, but been in business yourself in operations of big businesses and service businesses. And you're actually pretty unusual because you're a registered tax agent, you're an accountant, you're a CPA, you're an authorized financial planner, but you've been around for a long time. And now for the last couple of years, you've been my business partner in Metropole Wealth Advisory, helping clients with tax structuring, asset protection, estate planning. So who better to learn from than Australia's leading wealth strategist? So Ken, now with all that preamble, let's get on with it. What would you like to tell us about how to legally minimise our taxes?
Yes, thank you, Michael. I think the first thing is you've got a plan. So every business owner does a budget, a forecast, a strategy, but they only look at the business. What you also need to do is have a look at how your tax is going to be rolled out. So I recommend having at least 2 tax planning sessions every year, one about mid-year and one towards the end of the year. So you should be proactive at looking at your business, where the cash flows are coming from, where the expenses are, where the leakages are, to actually see if you can tighten up the way you operate your business to actually increase cash flows and reduce your tax. And why I recommend that you have 2 and not 1 is you want that planning to actually start, can I say, flowing into your BAS statements. So you don't want the last quarter to do a whole year's adjustment because it does look funny to the taxman. And you've lost the use of that money during the year. And don't forget, paying tax is after-tax money. So it's actually a significant dollar that you're losing that you haven't been able to invest in your business or use personally.
So what you've got to do is plan to become the business you plan to become. You've got to actually do it with somebody outside as well. And while accountants are good at this, financial planners probably are not. But a wealth strategist who has a more holistic view is probably the right person to speak with about this. Clearly, the ownership structure that you run your business in is important, but there are a whole lot of options, Ken.
Correct. And look, I would almost put this at the top of the tree. And it sounds funny when I said top of the tree. It actually becomes the bedrock foundation that you're going to build your successful business. And what I find is a lot of people get the wrong advice on the structure, because you can start off as a sole trader, you can be in partnership, you can have a company, you can have a trust. But can I say, anyone who is entering business hoping to be successful must have a trust and a company as part of their business ownership structure. Does the company come first or second? Will depend on what sort of business you're in, what's your working capital requirements, how long it takes you to turn over your working capital, your debtors, your creditors. By that I mean how quickly people pay you and what sort of extended terms you have. So can I say, for most businesses, I would say every, but I'm just covering my bases, sole trader and partnership structures are probably the two least optimistic or opportune. It's got to be a trust.
So that's the way a lot of people start, Ken, and they say, I'll do it later. It's a bit too complicated. Different ownership structures obviously give you different tax benefits. People are reading in the news, I guess, that they're hearing companies are favoured with lower tax rates. Other structures allow a different way of distributing income. There are a lot of factors to take into account, aren't there?
Correct. And if we look at just a couple of the high-level ones, if you're in business, you want asset protection, you want flexibility, you want to be able to pay the minimum tax legally, and you want to be able to generate cash flows. So sole traders and partnerships, 99.9% of the time, do not tick those boxes. The other big thing is you've got to look at how you're going to grow your business, whether you're going to sell in the future, because that will also dictate the structure. So for all my clients, we basically look at a trust and a company. And the trust gives us flexibility of distributions. So that means we're not always chasing tax recoupment. I'd rather get pre-tax money, pay my tax, than receive after-tax money and chase the taxman for a refund.
Now, Ken, some people are going to say, I should have known this before I set up, but I'm already in business. I'm already running a business. Is it too late?
Look, you'd have to say in the majority of cases it is not too late, because the ATO, or the tax legislation, has got quite generous restructuring provisions. So for a lot of business owners, the ability to restructure really doesn't trigger any tax issues.
So the first of the 9 strategies we're covering today on how to legally reduce your tax as a business person and as a professional is to run your business in the right ownership structure, and it's going to have other benefits, considerable other benefits than tax. And in fact, that's the least important reason to set up a company structure. In fact, it's not a good reason to do it, but there's a great benefit. Ken, how do I get to pay myself? Does that make a difference?
It certainly does. And what we find with new clients is the structure that they've set up, they're channeling all that income to themselves, which puts them in the highest tax bracket. It forces them to pay tax every year on the full earnings of their business. So What we need is a structure that pays you, can I say, the minimum as a wage? Because having a minimum as a wage means you'll lower your PAYG tax, you'll have lower payroll taxes maybe, your PI insurance could be favourably adjusted. So you've got to look at multiple income streams from your business. One of them is your wage, and we've talked about why we want to keep that low. But you also want to look at topping that up with distributions from your trust and dividends from your company. And a lot of clients come and see me and say, but I'm trying to borrow money for, investment purposes. And the bank always asks me what my wage is. Can I say, if that's the case, you're not presenting yourself to the bank in the most opportune way. You've got to find a good finance strategist that will take you to the bank as a whole. So what is your business income? Who in your family is getting income? And aggregate all that as your income when you're justifying a loan. And when we do that, we normally find that banks are a lot more susceptible to looking at you more kindly, because you've actually reduced or you've increased your cash flows by having these multiple streams. And periodically, if you've done very good in 1 year, you can actually postpone paying tax that year, and certainly postpone paying it at your marginal tax rates, which is the same as actually getting a tax deduction. If you've got to pay taxes 2 years in the future, that's better than paying it all now.
So, Ken, what you're suggesting is you don't have to just pay yourself. There are other family members or structures, related entities you could pay. And I guess one of those would be a corporate beneficiary.
That's right. That's what a lot of people call a bucket company. I don't like that term because it's sort of, it's almost red rag to a bull to the ATO. But a corporate beneficiary is an entity that will receive funds from your business to park it until you need it. So that way you're paying tax at the corporate tax rates, which is now starting to slide down towards the 25% rate for those small businesses. And you park it there to either invest, having only paid the 25 cents tax, or to top up your income when needed, and you then pay the top-up tax between your marginal tax rate and the company tax rate, but not when you generated the profits, but when you use the money. So again, you're postponing. The other thing it does is it strips out of your operating entity cash flows that could be at risk with a successful lawsuit. So you want to always flush out all your tax and all your profits to a safer environment. And look, I would go one step further, and if you've got a lot of intellectual property, I would own that intellectual property in a separate entity and then lease it to the operating entity, because that allows you some more flexibility with tax, but also it creates much better asset protection in case of a successful lawsuit.
So what you're explaining to us, Ken, is the importance of having the right ownership structure, or in fact structures, because there could be multiple entities there where you can distribute your income to companies, but also you've probably got to look at sending it to a wider pool of people.
That's right. So children under 18 are taxed at 66 cents. So distributions from your business as profits to young children is not very tax effective. But if they work in your business, if they come and help, empty the waste paper baskets, they help with the mail, they help with, some IT issues, then you can pay them a wage equivalent to the work they do. Once they're over 18, if they're studying, then obviously you can distribute money to them at the adult tax rates. So with many children going on to higher education, they've got periods of fairly low income, so you can distribute to them. Have a look at your grandparents, your parents. So if they're at a point in time where they're, can I say, self-funded retirees, then you can top up their income maybe at lower tax rates. If they're on Centrelink, you can even top up their income, but stay within the Centrelink caps for both income and asset values. So all of a sudden you can spread that income across a wide variety of people to reduce the overall family tax rate, which actually puts more money in your pocket to actually distribute, have fun, invest.
Okay, the next strategy you've got's one I like. So let's have a chat about obsolete stock, old stock, writing off, getting a once-off quick tax benefit.
So when you buy stock, it actually doesn't become an expense. So you actually don't get a tax deduction. You only get a tax deduction when you sell that stock. And many businesses have got stock that they've had for years that's worth very little. I remember when I was working in the timber industry, and one of the first things I identified literally was $100 million worth of stock that had been generated over about 15 years. The business never got a tax deduction for it. So writing it off because it was all obsolete, it was warped, it had been outside, gave an instant tax benefit. Okay, it impinged on the profits that year, but profits are not the mainstay. It's your cash flow. And more importantly, your cash flow after stock. So I recommend all new business clients that I see to go through all their factory, their storerooms, their warehouses, and basically look for stuff that's got dust on it. If it's got dust on it, it's probably been there for a long time and unlikely to be sold in the short term. So write it off and get an instant tax write-off. If you ever sell it in the future, you bring it back into the books.
Okay, what about assets, Ken? How do you scrap those?
I don't know whether it's a man thing, but I know at home I've got a garage full of stuff that my wife would love me to throw away. But I think that's similar in business. So particularly old plant and equipment, especially if it hasn't been fully depreciated, send it off to the scrap metal yard, write off the undepreciated amount and get an instant write-off for that. That means it goes straight to the bottom line and therefore reduces your tax. And think about tax almost as an investment. If you can save tax, you invest it. And with growth in that investment, compound growth, that dollar value just keeps growing and growing and growing over the years.
Now, Ken, you talked about family members, but often we've got business partners, non-family members. How do you handle that? Is there a tax-effective way if you're in partnership with one or more people?
Absolutely. So if we're operating out of a company, then you should have a family trust as the shareholder. If you're running your business through a unit trust, you should own your proportion as well through a family trust. But one of the things I've seen is that some people don't want to spend that extra money on the structure. So putting aside my views, what I recommend is that they have multiple classes of shares. So that means they can have A-class shares that distributes, income and capital. They can have B-class that just distributes income, C-class for capital. And then they can have a mirror image of that for spouses in their business. So that actually then creates the opportunity to target a distribution of business profits to a specific person or entity, as opposed to it being an across-the-board distribution. That will create much more flexibility and the ability to postpone, delay, or reduce your taxes long term.
Well, as we're going through 9 great strategies to significantly reduce your business or professional tax, what's the next one you'd like to share with us, Ken?
Yeah, it's quite an unusual one, and that is if you've got multiple businesses, multiple structures, see if you can move business profits into an entity that's got losses. And just a couple of weeks ago, I saw a new client who, when I went through this strategy with them, they used an S word and said, oh, in the last 2 years, they'd paid over $200,000 of tax that they needn't have because they had a very profitable entity that they paid the tax on, and they had another entity that had losses. And what I showed them was the ability to transfer profits from the profitable entity to absorb the losses in the loss entity. So that means that you're paying tax on the net of all your entities. That becomes a little bit harder if you're in business with other people, but not impossible. So have a look at how you can aggregate losses and gains to actually have a net position where you only pay tax on the net. Another way to look at this is some people come and see me where they've got multiple companies and each company is a subsidiary of a holding company. And what we do there is we group all those companies and then again pay tax on the net, where you don't actually have to transfer funds. You just show them and group them together and only pay tax on the net. So a strategy that is very beneficial, unfortunately not used to the extent that it should be.
Ken, clearly there's some benefit people sitting with you as a wealth strategist, as a tax and business strategist to get ideas on how to substantially reduce their tax. Let's discuss the last one that seems to be a pretty popular one, and that's superannuation. How do business people use that?
I think this is, if you like, a very undervalued gem in the pool of things. Super is taxed at 15% on income, 10% on capital gains, and then in pensions, 0. So if you've got these surplus incomes, or if you're approaching retirement age, use the superannuation system to its whole. We see a lot of clients employ their spouses. The ATO looks very rigorously at how much you pay your spouse because they've got to get an arm's length income. And as such, for a lot of people, the income to the spouse is quite minor, call it $5,000, $10,000 a year. But what you can do is pay the full superannuation concessional payment into your spouse's super, meaning you can pay the spouse, call it $5,000 wages, but you can still contribute $25,000 into super. So that allows you to reduce your business income, and it starts building up what effectively will become tax-free income in retirement.
Boy, was there a lot of information there, and there's a lot more gold as well. So what do you do now? Well, I think the first thing you've got to realise is it's worth stepping back, looking at your business with an outsider, somebody independent, to give you advice on, are there opportunities that you're missing? Are there things slipping between the cracks? Are your structures still appropriate? And in my mind, the right person to do that is Ken Race, Director of Metropole Wealth Advisory. And if you'd actually like to have a chat with Ken, if you go to the address that's on the page and the screen at the moment, wealth.metropole.com.au, wealth.metropole.com.au, what you can do is organise to have a quick chat with him. No obligation, no cost, to see, is it worth you sitting down and having a better look at what's going on? Because I know what Ken does is, for many clients, create a strategic wealth plan and a business plan, but it's a personalised one. Having a wealth plan means you're more likely to achieve the financial freedom that you deserve, the business profits that you desire, because he's going to help you define your goals, define your business goals, define your financial goals. Ken's pretty honest. He's going to tell you whether they're realistic, especially for your timeline, and then he'll help you manage them and set up the right structures to maximize your wealth creation. And interestingly, I found with a lot of business people, Ken identifies risks they haven't thought of. And being Ken's business partner, even though I'm not involved in that part of the business, I continuously hear the great results that our clients get. I see them when they come to Wealth Retreat and they tell us how much they've saved, how they're now able to enjoy their lives. They're not just working for their business is working for them and their families. And I think this little diagram that you can see on the screen here shows the holistic view that Ken and the team try to put together. Now, quickly reminding you, anything we've discussed here today is not financial advice. We don't know your circumstances. We don't know your needs. So what we're presenting today is general information, but some of it may be relevant to you. So if you're in business, if you're planning to go in business, or if you're a professional, because if you are, you're a business person anyway. So go to wealth.metropole.com.au, and when you leave your details, firstly, you'll get a special report written by Ken on structuring, which is useful not just for business, but also for investments. Then you'll have the opportunity of having a short chat with Ken where you can explain what your needs are. He can give you a really quick overview. And then if you wish to, he can go into more detail and give you a strategic wealth plan, looking at how your business is going. And even if you're not a business person, if you're just looking for a strategic wealth plan to get you and your family to the next level, that's what Ken and his team specialize in as well. So Ken, thank you very much for your time today. It's opened my eyes. It's reminded me of some things. It's shown me some things. I think it's the sort of thing all business people should be looking at.
Thank you, Michael.